The greatest wealth transfer in real estate history is happening right now, and most investors are missing it completely. They are missing it because they are reading headlines, reading to sell ads. Headlines about a crash, headline about a bubble, headlines about climate. If you are sitting on cash right now, waiting for 2008 to happen again, you are making a mistake. You are burning time, and in this market, time is the most expensive asset you have. The wild boom is over. We admitted that the party is done. But what comes next is not a crash. It is something far more powerful for the sophisticated investors. It is the silent bull. Here is what we are going to prove today. We are going to look at the actual data for Miami in 2026, not the hype, the math. We will break down why single-family homes are decoupling from condos. We will analyze the migration patterns that the news ignores. And we will show you why high interest rates were actually a filter that removed your competition. We're going to give you the business plan for the next 12 months. Let's look at the macroeconomic landscape first. The amateur investor looks at the interest rate. The professional investor looks at the demographic shift. Miami-Dade County continues to see massive population growth. But it's not just about the number of people, it is about the quality of the income. We're seeing a migration of high net worth individuals from high tax rate states, New York, California, Illinois. They are not moving here because they like the beach. They are moving here because the math works. Florida has no state income tax. When you compare that to the tax burden of the Northeast, the savings are massive. Critics love to talk about rising insurance costs in Florida. And they are right, insurance is up, but we have run the numbers. For a high income earner, the tax saving far outweigh the insurance premium. It is a net positive for your balance sheet. This creates a floor on rental prices. It creates a floor on property values because these buyers are not over-leveraged speculators. They are end users with strong balance sheets. That is why the crash never happened. There were no desperate sellers. Now we need to get granular with these asset classes. You cannot just say, I'm buying Miami. That is lazy, very, very lazy. There are two different economies happening right now. Market A is single-family homes. Market B is condos. Let's talk about single-family first. In 2026, we project a steady appreciation around 4%. That sounds boring compared to 2021. You're right, but 4% compounded leverage is how generational wealth is built. Inventory is tight, demand is high. Why? Because millennials are forming families and boomers are retiring. Both groups want homes, not boxes in the sky. Now, look at the condo market. This is where the risk lives. We are seeing inventory levels rise to 12 months of supply. This is a buyer market. But why is this happening? Older buildings are facing massive spatial assessment. Recertification laws are tightening. Reserves must be funded. This is scaring away the amateur money. But for us, this divergence creates clarity. We are heavy on land. We are cautious on vertical. Unless you're buying brand new construction, the risk in older condos is currently mispriced. Let's talk about the debt, the cost of capital. For the last 2 years, rates were the villain. But in 2026, we are seeing the thought. The 30 years fixed rate is easing down to, in average, 6.3%. Now, 6.3% is not free money. We are not going back to 3%. Get that out of your head. But 6.3% is functional. It allows the numbers to pencil if you buy right. And here's the key. As rate drops, affordability increases. The Miami Association of Realtors forecasts sales activity to rise by 5.6%. That means competition is coming back. Right now, you have a window. The rates are still just high enough to keep the masses away, but they are low enough to make the deal work. This is the Goldilocks zones for the aggressive investor. You can negotiate prices today. You can refinance the rate tomorrow. You cannot do it the other way around. So, where do we put the capital? Amateurs buy in South Beach. They buy for the ego. We buy for the yield. We are looking at the emergency cores, Little River, Edgewater, parts of North Miami, Doral. Why these areas? Because they offer a mix of urban demand and higher cap rates. They are in the path of progress. We are also looking at workforce housing zones like Homestead. Why? Because the people who service the high net worth individuals need a place to live too. Rental occupancy in the urban core is holding at 90 to 92%. This is an incredibly healthy number. But you must be precise. You need to buy business plans that account for the new reality. Higher taxes, higher insurance, higher management cost. If you deal only worse with 2019 expenses, you are going to go broke. We underwrite the 2026. Let's summarize the position. The wild boom is gone. The crash is a myth. We are in the era of the quiet bull. Steady growth driven by demographics, supported by tax policy, but it requires a different level of skill. You cannot throw a dart and hit a winner anymore. You need to be disciplined. You need to be data driven. You need to treat the portfolio like a business, not a hobby. If you are ready to stop reading headlines and start reading balance sheets, if you want to architect a portfolio that survives inflation and volatility, then we need to talk. We are currently building roadmaps for Q1 and Q2. We are identifying the assets that fit this specific thesis. Don't wait for the news to tell you it's safe. By then, it's too expensive. Message us directly. Let's build your strategy.